Rithm Capital Corporation is one of the most misunderstood high-yield stocks on the market. Originally known as New Residential Investment Corporation, Rithm Capital changed its name in August of 2022 as it shifted from a mortgage REIT into a more diversified financial holding company. Rithm now operates in mortgage servicing, mortgage originations, real estate securities, loans, and private capital. The goal is to blend steady cash flow from mortgage servicing rights with opportunistic gains in other real estate and credit sectors. But the biggest reason investors are paying attention is the dividend. As of August 2025, Rithm pays a quarterly dividend of 25 cents per share. That is $1 per year, translating into a forward yield of nearly 11% based on a stock price of about $9. That is an extremely high yield compared to the broader market and even other REITs. But high yield often comes with high risk. So let's break this down. Rithm generates income through several business segments. The core is mortgage servicing rights, also known as MSRs. When someone takes out a mortgage, the right to collect their monthly payment can be bought and sold. That's an MSR. Rithm owns billions in MSRs, which generate fees and interest float income over time. This is a relatively steady income stream, especially when interest rates are high and homeowners are not refinancing. But it is also exposed to prepayment risk if borrowers pay off their loans early. Rithm also originates loans through several platforms, including NewRez and Caliber Home Loans. The company earns fees and interest margins, but is exposed to housing and rate cycles. In addition to that, Rithm owns real estate securities like agency and non-agency mortgage-backed securities, as well as residential and consumer loans. The newest part of Rithm's model is its private capital strategy, which allows it to invest in more flexible, high-yield opportunities and alternative assets. All this diversification means Rithm can pivot across credit cycles, but it also means the business is complex and harder to evaluate. Earnings per share can be volatile, and book value is impacted by interest rate changes and asset prices. That's why most analysts focus on distributable earnings, which is a non-GAAP measure of what the company can reasonably pay out. For the second quarter of 2025, Rithm reported distributable earnings of about 30 cents per share, comfortably covering its 25-cent dividend. However, in earlier quarters, that margin was much tighter. The dividend has been steady at 25 cents per share for several quarters, but it is not guaranteed. Rithm has cut its dividend in the past, especially when market conditions deteriorated. Looking back, Rithm's dividend history shows a pattern of yield-focused behavior. It has paid over 10% annually many times, but it has also adjusted payouts when needed. From 2014 to 2019, it paid dividends ranging from 48 cents to 50 cents quarterly. But in 2020, during the pandemic, the dividend was slashed from 50 cents to 5 cents, then gradually raised again to the current level. This shows management is willing to protect capital and prioritize sustainability when needed. Let's talk about risks. Rithm is highly sensitive to interest rates, housing market activity, and mortgage performance. If the Federal Reserve raises rates, it may help the MSR business but hurt originations and credit-sensitive assets. If home prices fall or defaults rise, loan losses could spike. Rithm also carries a lot of leverage, which amplifies both gains and losses. It is not a simple REIT. It is a hybrid financial engine that mixes multiple strategies to chase yield. That is powerful, but it is not for the faint of heart. Now let's look at the payout breakdown. Rithm's $1 per year dividend is paid quarterly at 25 cents per share. Based on the current price of about $9 per share, that is an annual yield of 11%. That equates to roughly $8.33 per month if you own 100 shares, or about $100 per year in income for every 100 shares. Compare that to traditional REITs like Realty Income or VNQ, and the yield is much higher, but so is the risk. My income rating is 8 out of 10. Rithm pays well above average and has shown a willingness to maintain the dividend when possible. My sustainability rating is 6 out of 10. The payout ratio is reasonable right now, but past cuts and sensitivity to the macro environment are concerns. My simplicity rating is 5 out of 10. This stock is harder to understand than typical REITs. My risk rating is 7 out of 10. The yield is tempting, but it can evaporate quickly in a downturn. My final rating for Rithm Capital Corporation is 7 out of 10. It is a strong income play for investors who understand credit cycles and are willing to accept a complex, high-risk financial structure in exchange for an 11% yield. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.